Hi, my name is Darren Joseph from HEJ.tax. We're the team that seeks to demystify that sometimes confusing world of international tax. And today we have the honor and privilege of having a conversation with the world expert on information sharing agreements, Mark. Mark, would you please introduce yourself to those who don't already know you?
Yeah, so I have been specializing in automatic exchange of information and exchange on demand for 20 years, and I've consulted with the EU Commission and the OECD, and I focus exclusively on automatic exchange of information. I don't do anything else.
Okay, that's great. What is the major difference between FATCA and CRS regarding the treatment of non-participating financial institutions?
Okay, so CRS, there are four types of financial institutions. The only financial institution that CRS tackles is the investment entity. They don't tackle non-participating insurance and depository and custodial institution. So CRS deems or treats
Mhm.
non-participating investment entities as a passive NFE,
Yeah.
subject to look through to the controlling persons. It doesn't matter who the controlling persons are after that. If it's another financial institution, you still carry on looking. You don't
Mm.
stop. So you look through financial institutions. So that's for people trying to use investment entities in about the 80 countries that haven't signed up to CRS. Um, all other types of non-participating financial institutions are not looked through for CRS.
Mm.
So that's a weakness that I use for CRS. But as I said, we're going to be focusing on FATCA today.
Okay.
Now,
Mm.
FATCA, on the other hand, endeavors to penalize non-participating financial institutions who don't register for a GIIN by
Mhm.
regarding them as recalcitrant. So the way to penalize it is the underlying financial institution or paying agent must withhold 30% on any payment sourced from the US, such as dividends, interest, sale of financial assets, any payment that comes from even rent, any payment that's paid to that non-participating financial institution, any type of financial institution, not only
Mhm.
investment entities. And on top of that, these non-participating financial institutions are encouraged to close the accounts. The banks are encouraged to close the
Mhm.
accounts of non-participating funds, but it's not mandatory. The weakness
Yeah.
here is if there's no payment received by the participating financial institution, if it's merely just holding the assets and not receiving any income, then there's no
Mhm.
30%, there's no recalcitrant. So that's a major weakness, okay?
Mm.
So the weakness that I focus on is a custodial institution holding the shares of an investment entity but doesn't receive any payment from the underlying investment entity. Then there's no penalty. They will try penalize it if there's a trust and the underlying company. We'll get to that in a question or two.
Okay, thank you. Mark, thank you very much for sharing your time, your expertise. If someone wanted to reach out to you directly to find out more, what's the best way to find you and contact you?
You can just find my website, which is co-ownershiptrust.com. That's with a dash. uh,
Mhm.
or a or a Google search of my name and trust, and you should find me very quickly. And then WhatsApp me.